Hello and a warm welcome to Talking Stocks. I'm Kukule Tutsele. In studio with me, Sean Ashton and Liam Hechter, both from Anchor Capital. Now today we're talking Steinhoff, an integrated retailer that manufactures, sources and retails furniture, household goods, as well as general merchandise in Europe, Australasia and Africa. Gentlemen, I think whenever I think of this company, it's just such a significant juggernaut within the South African and Pan-African and even global context of things. But let's put it into perspective again, just how big Steinhoff is and the level of exposure that they have across the globe.
It's become a big business, 330 billion rand market cap, alongside the exposure that you spoke about more recently, they've entered the United States. So this has really become a global business now. In fact, there's not many continents that they don't operate on. South America is the obvious one I can think of. But yeah, it's a.
What about Antarctica?
And Antarctica.
Nice one there, Liam. I didn't see that one. But I'm not too sure what you do with a mattress company in Antarctica anyway.
Probably
but
not much.
Not much. Let's talk about that deal, a significant deal. And again, I understand valuation also came slightly under pressure versus how much they actually paid for this particular asset.
Absolutely. So I think this is first of all, it's their first foray into the US. It's not a continent that I think that they are hugely familiar with. They've obviously dealt with Europeans for a long time, and I think if there's a risk associated with a deal, it comes down to the culture of operating in a different time zone and a different people, I guess. A very large deal. It's an equity value of about $2.5 billion, but they're taking on quite a lot of debt inside a mattress firm. There's about another circa $1.4 billion. So $3.8 billion worth of debt that they're assuming to do this transaction. It's the largest mattress firm in the US. They've got a 15% national market share. That business in and of itself has grown quite significantly via acquisition over the last 5 years. If you look back 5 years ago, they had about 500 outlets. They've now got about 3,500 outlets from East Coast to West Coast. So it's pretty much got the US covered from the perspective of mattress retailing, and more than twice the size of the next largest operator.
But just from a scale perspective, how significant is this deal when it comes to I understand that there was a figure that was passed around in the media recently that one in every third mattress will be actually distributed by Steinhoff. Is that correct on the back of this deal?
It may well be true. I mean, they will be the largest mattress retailer in the world, I think, is probably the right thing to say now. And that I think is a key part of the transaction. So when you look at the deal metrics, the price that they've paid is about 30 times what we could expect them to earn this year in terms of what mattress firm has guided. So I think there's been a few eyebrows that have been raised about the steep metrics that they're paying for this company. And I think there's two facets to this particular transaction. I think I would probably say that it's unlikely that this deal would have happened if we didn't have the cost of capital environment that we do have. Debt is incredibly cheap. Our understanding is that they've raised transaction financing at between 3% and 4% in dollars. So you can pay a 30p and still land up in a situation where, by our estimates, it adds close to 2% to group profits on consolidation in a full year. But I think further to that, one thing that's become quite obvious when you look at the metrics of mattress firm itself is that the operating and EBITDA margins have been in decline over the last 5 or so years, to the extent that we think they'll make single-digit EBITDA margins for the coming year. And if you look at Steinhoff's existing retail and specifically bedding businesses in Europe and the UK, they're making kind of 13 to 15% margins on those businesses. So I think as a result of better global sourcing, putting a bit of pressure on their suppliers to an extent, they can probably add significant margin to mattress firm in time to come. And I think that's got to be a big part of the thesis. Now, if you normalize mattress firms' margins for what margins they're making in the rest of their businesses in Europe, it can probably add 12% to Steinhoff's profits on this year's numbers, which is significant.
Very significant, and perhaps this also takes us into the next element, which is obviously understanding the opportunity here for assuming the cheap capital that Steinhoff has obviously raised and the earning potential that this particular company can offer to Steinhoff in the long term. From your perspective, Liam?
From my perspective, I would say that the mattress firm deal represents Steinhoff's entry into a new geography, and I think it's going to be a big test in terms of management depth, whether or not they can execute on this. I think up until now, you'd have to give them the benefit of the doubt. They've executed extremely well in Europe and the other geographies that they've entered outside of South Africa. So over the years, I think the management have built up a pretty good track record, and at the moment, you'd probably give them the benefit of the doubt, although this is a big bet for them. I think, from a sheer absolute size of the transaction and as well as the increased sort of complexity of doing business in the US, I think if they can execute well on this and set up a big distribution network in the US, they could probably lay a good platform for expanding into other retail classifications, I think, in the US.
And maybe let's build on that, because they also have Poundland, another deal that they recently acquired, and then Darty kind of turned a bit sour, if I'm not mistaken. But given the geographical exposure, Africa is certainly accounting for very little of their earnings in the future. So again, this European focus with the global reach, something that will work to their competitive advantage.
It's becoming quite small. I mean, if you look at the retail mix going forward, and bearing in mind retail is the largest part of what they do now. Obviously, there's a sourcing and a manufacturing element, but they're more a retailer than otherwise now. The US on a pro forma basis will be about 20% of retail turnover, and you're talking 85% developed market exposure. So Africa, I think, is becoming quite a bit smaller going forward, even despite the fact that you've now consolidated in this year the Pepkor business for a full 12 months.
Mm-hmm.
And I think it just makes sense as the company grows, that they need to find bigger markets, and the scale that they're looking for you'll get in the first world and developed markets. So I think that they probably ran out of opportunities to grow in this part of the world.
Another element that you've mentioned is that they have certainly raised quite a bit of capital, especially on the back of their Frankfurt listing. But what about their debt? Is that something that we need to be concerned about on their books?
I think they got to a point, Gugu, where they were actually quite unleveraged compared to their history. So if you look at last year's numbers, I think at balance sheet date, and these are the figures that have just been recently released. At 30th of June, they had about 1.5 times debt to EBITDA, which is actually quite low relative to where they've been in the past. And they've taken on quite a lot with Poundland and with Mattress Firm. It's probably about 4 billion euros worth of debt collectively that's come onto balance sheet through those transactions. They've also issued some convertible bonds, but they haven't yet deployed the proceeds from that. That's another 2 billion odd euros, but you've got to count that as cash for now, I guess. So they're sitting in a situation where debt to EBITDA is probably about 3.5 times at the moment. So it's we can't say that this is an unleveraged business anymore. I think they've taken on quite a bit of financing to acquire these platforms. And for me, it's about what's absolutely key now is they've paid a lot of goodwill. There's lots of goodwill in this business, business's balance sheet. There's a lot of debt, and they absolutely have to extract the synergies that they would expect over the next 5 years, let's say.
Mm-hmm. I just want to touch very briefly on some incidents that were also reported recently. I understand there was some investigation into some tax documents at their office based in Germany. Despite all of that, are we still fully confident in Marcus Huerster and the team that he has at the helm directing the firm? I
would say they haven't given us too much reason to be doubtful for now, and I mean specifically more from an operational perspective. So I think what we were quite encouraged by was the kind of delivery of margin enhancement, certainly in the Conforama business. Which was a test bed for them. From a tax point of view, their last tax rate was about 15%. They've mentioned that they expect that to be sustainable going forward. There is this ongoing tax investigation, which they believe relates to a historical issue, which should be resolved amicably. It's quite hard to quantify what that actually means, but certainly they've attempted to provide the market with the assurance that it's not a nuclear bomb waiting to go off.
Let's hope not. Yep. Certainly not. But coming back to a company of this particular size, does it allow them to be quite flexible? Because another common theme with regard to the retail space, and especially in Europe, is technology and online furniture purchasing. Is that something that perhaps they might be nimble enough to attend to?
I think that's a very important point. And I think if you look at something like Mattress Firm, first of all, I'll make the point that I think furniture as a category is probably one of the less susceptible lines of retail to being decimated by online, and I think and mattresses in particular, in the sense that ultimately, if you're going to go and buy a brand new bed, you want to line it first and kind of feel what it feels like. It doesn't mean that you have to have piles and piles of stock at a store level. You can still have the delivery mechanism much the same as it would be for an online retailer, but ultimately, I don't think there's a massive risk that you're going to get to a point where you don't have a requirement for some kind of a storefront where people can go and test out the stock and the items, and then place their orders. The delivery mechanism can be the same as for online, but ultimately I think people are not going to just go onto my personal view. I've recently bought some beds. I didn't go onto a website and just go click and have them ordered.
Took your kids with them, made them jump on
For
the
sure.
bed, feel it out first.
Absolutely.
Well, on that note, let's get our expert's view now as to whether to buy, hold or sell Steinhoff as a stock. Liam, coming back to the big question, buy, hold or sell Steinhoff, again taking the valuation of this particular counter into account.
At the moment, it's trading on about a forward 14 times next year's earnings, and I think with the inclusion of Pepkor in this business, I think the rating is probably justified at these levels. Would be nice to see a clean set of financials like for like, which you're most likely not going to see, as the strategy in this business is clearly to grow via acquisition. But yeah, I think it's got a sustainable moat around the business that it's achieved through scale. Vertical integration should continue, and I believe that this is certainly a stock that we would want to own.
Sean?
So it's re-rated a lot in recent years. I mean, you could buy this company 3 or 4 years ago, which we did at a 7 PE. I think the valuation moving from a 7 to a prospective 14 times is giving them a lot of the credit for what they've done in creating a much more scalable global business and an integrated business. I think that and that forward rating is a consensus. It bakes in quite a strong growth number next year, about 20% growth. I need to get some confidence that will be delivered. So I think this year's numbers was a slight miss versus most people's expectations in terms of what they've just reported. I think it looks fair for now, but I think the risks have risen in terms of the delivery of future earnings. They have to extract synergies. And they've taken on a lot of debt in this recent corporate activity. But this is a team that we've backed in the past, and I don't see a reason why we shouldn't back them for now. So for me, it's a good hold. I don't think it's especially cheap, and I don't think it's outrageously valued either.
Well, we'll leave it there for today. Your views on Steinhoff, so clearly a buy and a hold. Am I correct, or hold?
Yeah, I would go with Sean's hold there. I don't think it's a screaming buy, but I think the quality of the stock deserves a place in portfolios.
A hold recommendation coming through there for Steinhoff as an investment opportunity, listed both here on the JSE and on the Frankfurt Stock Exchange. But a big thank you to both my guests, Sean Ashton and Liam Hechter from Anchor Capital, for joining us and sharing their insight with us. Well, that's where we leave it for this week. Do join us again next time where we talk more stocks.